The Rebel Capitalist Show.
I was actually on Chris Cole's website. I've been doing a lot of reading. He's got a new paper. Everyone's very familiar with the dragon portfolio and the allegory of the hawk and serpent. But he actually came out with another paper called The Rise of the Dragon, where he actually does back testing with the dragon portfolio for 2020 and compares how it did relative to like a risk parity portfolio, the 60-40 portfolio that most people know about through their financial advisor. And it's just staggering how well the dragon portfolio did. I think it was up like 52% or something like that. He's got the numbers in this most recent report. But anyway, that was kind of right on my mind. So we were talking the other day and you said, well, maybe let's do a video for some people who might be new to options, or maybe some people that have a little bit of experience on how they could kind of build this into their own portfolio, this concept of the dragon portfolio, while at the same time maybe giving them some information as to how they could use options to also create cash flow, which is something that I'm always interested in, being a real estate guy. So that's why we've got you here today. So I'll just hand it over to you so you can teach us how to work the dragon portfolio that did so well in 2020 and make a little bit of cash flow from these options.
Absolutely. So let's actually talk specifically about, there's two ways to approach income writing: through covered call writing and through put selling. Okay. And so I want to compare the two a little bit and help everyone understand how this works. But covered call writing involves us owning the physical shares of the stock or ETF or commodity or currency or whatever we're option writing on. Okay. We physically own the shares. And so at this moment, we are not taking any risk different than a shareholder at this moment. We basically own the same shares you would own anyway. But what we do is we sell a premium to collect this income upfront for giving the speculator the right to be able to buy that stock from us at a specific price over a specific period of time. We basically rented a speculator the upside of that for us.
Just renting it to them so they can sell it short?
Well, no, we're renting their right for them to have the upside of the security. So they have the right to buy the shares from us. Okay. And participate on the upside.
Yeah. And see, guys, I don't understand this stuff either. So if I can get it, Patrick is here to teach me. So, you can definitely get it as well. I've just as many questions as you do.
So George, the way that I like to describe it is this: it's bird in hand versus two in the bush. In other words, if I said you could own the stock and that stock might make you 20%, but it might not. It might stay flat. Or I'll give you a guaranteed 10%, but you can't make more than that. That's bird in hand versus two in the bush. Someone will say, well, I'd rather take a guaranteed 10 than the chance I might make 20, but I also have a chance that I might make nothing. And so so it's a game of winning through base hits rather than home runs.
Yeah. What is the mentality of the other side of the trade?
The speculator, which is that someone who actually believes that security has a big upside, and they're willing to pay a premium to leverage up their upside potential through the purchase of the option, right? Okay. And so that they're being a market timer, you're being just a premium harvester, and so it's a win-win in a way, George, because what you want to think is that if I just want every single month to make an X% return, and the speculator is the one saying, well, I don't care about month to month. I just want to hit a big one. And I want to hit one where I'm going to make, hundreds of % return on my speculation. And I'm going to just be fishing for this one trade that's going to make me this win. In the end, if you end up losing your stock and you made 10%, but the speculator bought the stock and they made a big return, in the end, you both won. It's just you won by having a guaranteed upfront return, and they won by having been correct about the upside of the security.
Yeah, it seems like it's a way to monetize the hysteria in the market right now with the stimmy check Robinhood crowd.
Well, there are there are a number of people that are doing all the premium grabbing on the GameStops. Like we could look at
like that.
but there are some big premiums on that. We can go there actually. We can even do that because I wanted to actually do real examples here. Like, I mean, we're doing a lot of presentation slides and there's a lot of words on here, but let's actually do some real examples and look at this. I'm just gonna pull up on my screen. We'll take a look. Let's use something like BTU, which is Peabody Energy. This one here is a coal mine. Coal mining stock. It's at $6 here. So let's just say
Patrick, because a lot of my viewers are very bullish on commodities and coal.
There you go. So let's say we own Peabody here, and we own 100 shares. It's $580 to own 100 shares of this BTU, right? So it's $5.85 for the shares, right? And so now what we're going to do is we're going to turn around and we're going to say, well, you know what? I could have the unlimited upside potential of this stock, but I could also sell a covered call and earn a guaranteed income. So right now, a June $6 call option is paying 70 cents. So right now, I could turn around and sell one covered call right here for 70 cents. I'm just going to do it at the prevailing market price and earn $70 of income. This $70, it's showing a $70 liability because my cash balance in my trading account just increased by $70. I literally had $70 deposited in cash in my cash balance. And that $70 is as real as a dividend.
Yeah.
Now, what's 70 cents on a $6 stock is over a 10% income return in just over 30 days.
Right. But the catch is if it hits the strike price, you got to sell to them.
Right. So now you do have to sell if it does go to, you don't have the upside above 6. We've given that to a speculator.
Yeah.
But if I turn around and I'm consistently grabbing 10% a month, like this example, how much did I make in a year if I grab 10% every month?
Yeah, right, 120%. And then if it doesn't hit the strike price, then you still own the shares and the premium, right?
And you got to keep the premium. The point is that when we go through the exercise, now I'm not telling everyone to stop buying stocks and just do covered call writing. But let's look at option writing as an asset class, which is we say, okay, I'm going to have a 50% allocation to equity. I know like Chris Cole has his version of what is the right amount of equity in a dragon portfolio. But let's go with the idea that 50% of our assets are allocated to equity. Right. Why not have 20% of that dedicated to premium harvesting and 30% to the upside appreciation of those securities? What you've done is now created a diversifier inside there. You've created a component of your equity that is not reliant on the market having to go up in order for you to make your income return. You're creating an alternative way of generating returns in your portfolio that isn't reliant on appreciation. Right. And so it's one of those things that is as a choice for generating that return. And so so we can go through all the different scenarios of what happens. But the key that you want to take away is that we made a guaranteed 70-cent income, which basically means, let's just put up the Peabody chart right here, which is that even though we bought the shares right now up here at $5.80, nice chart, and had a pretty good move here in the last few days. But our break even on the shares is actually $5.20 because no matter what, we get to keep the 70 cents.
Yeah, right.
Our cost base on our shares is immediately 70 cents improved. In other words, we would need a drop below $5.20 in order to start losing money.
Yeah, right.
And so somebody who turns around and is consistently grabbing income premium, they're turning around and consistently reducing their cost base and creating alternative cash flows. Now, this was an at the money and immediately.
I mean, theoretically, you could do it if you did it like 5 or 6 times in a row, depending on what you were getting up front. You could be playing with the house's money.
Absolutely. You basically can turn around and pay off the entire shares,
Yeah.
and then you turn around and you can sit there and harvest premium on shares that were completely paid off. And this is the part that I love about this, is that you have to look at it not on an individual share basis, because there are thousands of stocks that you could sell option premium on. And so just because we lose Peabody, let's say a month from now we lose it and they're forced to buy it, well, I could turn around and buy Alliance Resources. I could turn around and start writing on Warrior Met Coal. Like if there's a million coal companies out there, and if I lose Peabody, I'll just turn around. Like Peabody's up here, but let's say you go to Warrior Met Coal. Now that stock is more at the bottom end of the range. So guess what? Now if I lose Peabody, I'm going to go and find another coal miner, and I'm going to do the cover call my next cover call on this stock. But the key is to always be grabbing premium. That's the whole point of premium harvesting. It's the exercise of having the options market paying you consistent returns over and over again that makes the strategy so powerful. And you can create this return. So let's just do a quick
also assume, Patrick, that the amount you're getting paid up front is predicated upon the volatility or the probability of the stock reaching that strike price. And so you could, if you got really good, you could find ways where there's kind of what you consider to be asymmetry in in the odds that kind of the market maker, if you will, is attaching to the stock hitting that strike price. Therefore, in your previous example, you talked about getting 70 cents, but in another type of market environment, or maybe with another stock, you could have got $1.40 or $1 or something like that.
Absolutely. And so let me give you an example. All right. So let's just go with this being actually, I have to zero this out. So what I want to show you is that this at the money covered call on Peabody basically generated us a 13.46% return in 38 days.
Yeah.
Right. Okay. Which annualizes at 128% annualized. But but like we were saying, your average cost base or your break even is $5.20. So now you basically have immediately a 12% downside protection, because the stock would have to drop 12% just to get to your break-even price.
Yeah.
On that. Now, based on the math and options pricing, because it's a probability distribution curve, this is this option is being priced at a 47% chance that you're going to lose it.
Yeah. So who's coming up with those probabilities, Patrick?
That's the implied volatility and where the strike price is relative to the stock price.
Right, but is that a formula, or is that someone?
Yes, the probability distribution curve is that skew that exists inside the probability skew that exists in the options market. Me and you could cover that in a future session and show how that option market is priced. But the point is that we can mathematically know that this option is being priced based upon the assumption that there's a 47% chance you're going to lose the stock in a month, and a 31% chance that you might be under 520 in a month. Like that is your math that actually that is inherently being built in.